Now, Goldman Sachs, as I was saying to you, say that stocks could plunge 25% if the 10-year yield hits 4.5% by the end of this year. Now, the bank's base case scenario is still that rates will hit 3.25%, but the stress test that we talk about is at 4.5%, and it indicates such a move could cause stocks to tumble. The economist Dean Struven also reckons that the economy would probably suffer a sharp downturn, but not a recession. And you've got the recent market decline was fueled by concerns tied to the yield approaching 3%. So let's bring in our guest this morning. It is Ilya Spivak, Senior Currency Strategist for Daily FX. Good to see you this morning, Ilya. Thank you for joining us both. In terms of this as our headline story, this is a worst-case scenario, but it raises the debate about what would happen ultimately in the markets if you saw a busting out of this yield. What's your base case? If you look at 3.25%, 4.5% in a disaster case, what are you targeting in terms of yield?
Very good to be here. I think it's very, very real to get into the 4 territory. I'm not necessarily looking at a very firm number above that, but I certainly see that we can get north of that this year. I think we saw at the beginning of this month just how worried the markets are about tightening, and all this talk about rate hikes is of course important, but we have to also remember that in the second half of this year, the combined quantitative easing we've gotten from the Fed and the ECB will become negative for the first time basically since the crisis. And I don't think the markets are really appreciating how quickly that can accelerate, especially if the ECB actually ends asset purchases in September, as is currently the idea.
There is a sense of anxiety in some of these markets as we speak, Ilya, and I want to go and look ahead to the speech from Jay Powell. Maybe we're going to get a more hawkish outlook in terms of not necessarily an acceleration of rate hikes, but the potential thereof. Just a little bit of preparation for possible slightly faster schedule?
I certainly think that is a very real possibility, and I think what the markets are really a little bit underpricing is what happens next year and the year after. At this point, the market is almost in line with what the Fed said in its last forecast for this year, but in my opinion, the view for 2019 and 2020 is very much underpriced, especially if this baseline scenario of coordinated global growth is actually what's going to happen. The interesting thing is, even if it does not, and we do see a borrowing costs inspired sell-off and another round of risk aversion, well, then the U.S. dollar finds that haven bid again. And I think essentially each way you look at this, the U.S. dollar looks relatively cheap to where it is, maybe at the end of this year, early next.
Well, it's certainly a crowded trade. I think that would probably be the understatement of 2018. Do you think that Powell needs to establish very clearly that there is no Powell put? I mean, the recent minutes from the FOMC suggest that they talked about asset prices. Is it important that there's no Powell put exemplified in the opening sweeps of conversations from him?
I think that is certainly something that we'll be looking for. It has come out, of course, in comments from Jay Powell going back to 2012 that he has been concerned about asset valuations as they've been buoyed by the very aggressive stimulus we've seen for quite some time. And if we get that kind of thing in this testimony and he's vocal about it, that certainly can be something that weighs on markets. The sense has been that he's willing to prick the bubble, as it were, and see these asset valuations deflate some and come back to what he would perceive as more fundamentally based values. And I wouldn't be surprised to hear that.
Ilya, we've put this up on a chart, the Goldman call. Our clients can pull this up easily at G space hashtag BTV space 9684 in terms of their call that stocks may plunge 25% if that 10-year yield hits 4.5%. Higher yields, maybe in traditional monetary policy, would translate into a stronger dollar. The Bloomberg Dollar Index down another fifth to a quarter of 1%. Where does that trade go? The greenback.
So I think the very sort of telling thing that we saw really happened at the beginning of this month when we saw that jump in wage growth from the jobs report out of the U.S. and the subsequent sort of run we saw from stocks, that was very clearly accompanied by a bottoming and a sort of tepid recovery from the U.S. dollar. I suspect there is more of that we see, and we return on the offensive on the U.S. dollar if, in fact, this tightening scenario is going to be more aggressive than the markets have accounted for. I don't necessarily see a aggressive decline in stocks, though that certainly is a possibility I'm entertaining, but I don't think that needs to happen for the U.S. dollar to come back on the offensive. I think at this point it looks rather cheap.